For those of you who don't know me, I'm Alan Woolley, recently appointed as Chairman of Wealth at Work. I'll add my welcome to David's, but I'd like to introduce you now to Neil Fraser, who's Head of Pensions from Schroders, just to give you a sense of at least what one organisation has done in response to this particular challenge. So, Neil, thanks.
Okay, thanks, Alan. Okay, so the first thing I was going to say is I've gone horribly off brief, but actually listening to Roz's piece, I think I might be more on brief than I realised, so that's good. So what I wanted to do today is just run through a little bit around what we're doing as an employer. So the focus is very much on the employer, not the trustee, although obviously everyone's aware the trustee has got such a key role to play in sort of trust-based schemes. But so there we are. Great stereotype, but you sort of get the picture. It's time spent doing exactly what you want to do, floating around, not a care in the world. Simple. However, I think that potentially is the reality for many. There's not enough money to do the things you want to do, and rather than being a happy retirement, it's one that's fraught with concern and worry about where the next sort of income stream comes from, or where the next pound to spend comes from. Okay, so rather scarily, these next points that I put up are coming from genuine conversations we've had with employees. You might not be surprised by some of them. And I think this picks up a theme. There seems to be a bit of a view out there that actually just get the right annuity when I retire, it's all going to be absolutely fine. Well, it sort of is, maybe, but only if you've not made horrendous mistakes for the previous 30 years. If you've made a whole series of mistakes, or you've not planned effectively, or you've not made adequate provision, picking the best one from 3 annuity rates is actually not going to solve your problem. This is one that we get frequently. We actually have a pretty generous pension scheme, so that's fine. The downside of that is huge complacency amongst the members. They sort of sit there and say, well, the scheme's good, it'll be fine. So you say, that's good, glad you're happy. Do you actually understand the scheme? And then there's sort of normally a moment of silence, and then it's, well, not really. I think you put something in and, it grows and it's all good. So having a good scheme is a positive. Unfortunately, as I say, it does breed a bit of complacency. Another classic, which I think probably people will be familiar with. We've got a default investment strategy. Well, clearly that's the one for me, otherwise it wouldn't be there. That must be the best fund. Now, for some, it may be, but it's clearly not a catch-all for everybody. People have very different attitudes to risk, and they have very different plans, and they have very different positions outside of the workplace. And I think one of the mistakes it's easy to make is that you only focus on people's position within the company. You make great assumptions around what their general wealth or plans may be. So just sticking their money in a default strategy, leaving it for the next 30 years, picking the best annuity rate, fantastic. Doesn't really work like that, as we know. And this is the one that is a real eye-opener for most. You say, well, are you sure that you've really got enough? Have you thought it through? And you'd be absolutely staggered how many people say, well, I'm not going to spend a lot anyway. Right, okay. We'll come on to that. So, with that as the backdrop, we basically, probably 18 months ago, sat down and said, well, even with our workforce, who are pretty well catered for, there are some clear issues. We closed our DB to accrual in 2011. It had been closed to new members for some time before that, so we only had about a quarter of our staff actually in DB, 3/4 in DC. Closing it was a fairly painful process, as I'm sure most of you are familiar with. But once we'd been through that, there was a sort of recognition that as an employer, what should we be doing? Because there was this fundamental lack of understanding out there. So we basically decided that we were going to approach it from two perspectives, really. Firstly, to make employees very clear that it's their responsibility. They have to make their own decisions. Of course, the big problem with that is most of them don't understand, A, what they're looking at, B, what they need to do, or C, how to do it. So we gave a commitment that basically we would set out on a programme of providing employees with education and support around all financial matters, not just pension. And again, I think this is something that Ros touched on. Pension is not the be-all and end-all. You know, I think the financial landscape is changing quite dramatically, and there has been this sort of tunnel vision that get your pension right, all will be fine. But as we know, there are increasingly large restrictions around what you can do, when you can do it, and I think Ros has covered the annuity issue pretty well. So let's start with basics. Let's try and educate our employees so that hopefully they feel empowered and enabled to make some decisions that are relevant to their own position. Okay, so I'm going to spend the next couple of slides just going through what we were doing, and I appreciate that this won't be relevant to all employers. It may not be possible for all employers, but hopefully there's some ideas in there. So at the start of last year, we set out a programme that we would hope, or were hoping would cover all of the different career phases. So we actually set up 6 different programmes covering right through from interns. We have interns in for a 6 to 8 week period during the summer, then the graduate programme, and then these become sort of fairly loosely defined, but early career, mid-career, late career. Rather worryingly, we were seeing the same employees pitch up for all 3 at different times. And then the pre-retirement stage as well. So I'll come on to those in a little bit more detail. We did actually have very specific agendas, but for the purpose of today, I've sort of shortened those and bracketed a few bits and pieces together. So interns and graduates. Now, a lot of people, I think, don't really focus on these, but logically, these are potentially the senior employees of the future. And again, I know we may not be that representative, but we have 3 members of our group management committee, which is 1 level below board, who actually joined on our graduate programme. So there's a little bit of longevity in terms of service. But I think ignoring these sort of people can get everyone off on the wrong foot, really. So this was fairly basic. I won't go through all of these individually. So just the fundamental of working for the first time, income. And again, we're looking at grads coming from, you know, the top 10% of universities. And the sort of feedback that you were getting on this was again, staggeringly wide. To some, it seems a bit of a strange concept that they didn't get to take home all of their money. And yet others were coming in and say, well, I know all that. You know, I've been operating a business, you know, while I've been at university. And so again, the range of understanding, even at that early stage, it is quite staggering. So this was fairly basic. So we went through managing and repaying student loans. Again, people in different circumstances. It ranged from, well, I never had a loan, my parents paid for it, to some with, you know, I've got a huge loan, I've got no idea how I'm going to get rid of it. So they're 2 identical employees, more or less, sitting next to each other with completely different considerations right from day one. Then just some, you know, basic how to build up a credit score, why you might need to do that, why it might be useful, and then just fundamental sort of good housekeeping. You know, don't stick with Vodafone or whoever, because actually if you shop around you may get a better deal. It could be £10 a month cheaper. What might you do with that £10 a month? Could that go towards your student loan? And just trying to sort of tie all of these things up together. We had a very basic sort of overview of savings and investments. Again, you would think that an investment management company, everyone who works there understands investments. Very wrong. We'll come on to that again. But and just giving people a better understanding of the benefits that are made available to employees and how to make the best use of those. Again, the flexible benefits program is pretty generous. We are very lucky with that. But you would be amazed, again, employees at all levels who are ignoring cheap and efficient benefits internally and buying through their bank or through a local high street broker, because they, again, it comes back to Ros's point, education, they just don't really understand what they're doing. You know, so someone will come along and say, well, I went to Fred Smith IFA along the road, did me a good deal, and he'll sell them exactly the same policy. That's probably scandalous, but anyway, you get the picture. Okay, so we then moved on to earlier mid-career, and again, as I say, it's not clearly defined, it wasn't bracketed or targeted at particular individuals, it wasn't age-related. We just sent out invitations saying this may be relevant to you, these are the sort of things we're going to cover. Now, our thinking here was was the point at which the mindset of individuals might start to change. So, bring them all down. Okay, so from those early stages of student loan and going out and spending more than you're actually earning, which I think we've all done, it's now really at the stage of financially I'm starting to mature a little bit. I've actually got a bit of spare money each month. What can I do with that? We then focused on mortgage options, and that's another sort of dark hole we probably shouldn't venture into, but if you look at the number of different mortgage options out there, again, unless you're a genius, I think it might be a struggle to pick the best one, and much with the sort of mobile phone analogy. With mortgages, if you're in the wrong plan or on the wrong scheme or on the wrong rate or tied into the wrong deal, the implications of that are pretty significant. So then people are starting to move into the family sort of environment, and they're looking potentially to fund children's education, which again I guess many of you will be familiar with, and the costs associated with university education, how best to accommodate that. And it's at this stage that we first started really then starting to look at what the pension options are, what their longer term investment strategies might be. Our view was that targeting that at the interns and the grads was going to be a bit of a wasted opportunity. They haven't got the money, and frankly, they probably don't care at that stage. Whereas at this stage, they're starting to understand it a little bit more, they've been in the business a little bit longer, and at this stage, you can still make up for the poor decisions you've made in those very early days. You've still got time. You're playing a bit of catch-up, but so a little bit more around there, maximising tax allowances, using ISAs, etc., savings income if a partner's on lower income, transferring potentially savings into their name. So just trying to start thinking a little bit more widely around how to make the best use of their money. Because fundamentally it's their money, it's helping them understand how they can make the best use of it. Then we get on to the rather more sombre bits of death, disability, will planning. And the last one, I'm sure everyone's familiar, but we were staggered. You know, we have potentially a fairly sort of financially sophisticated workforce. We did a session on will planning, and we asked for a show of hands who had a will. And it was sort of bordering on embarrassing, really. And these people have got houses, they've got children, never given any thought to the fact that they made any will. So that was a bit of an eye-opener. Okay. So then we moved on to late career, pre-retirement, to say you can define that how you will, and it's difficult for us to target particular groups and say, right, you're 53 and a half, this is one for you, because outside of the workplace you don't know what people's plans are. So I'll bring all the points down. We felt at this stage that involving employees' partners became quite key. So we actually ran for the first time as a pilot a session in the evening. We invited employees' partners along. Now I'm not sure if it was the content, the excitement, or actually all the free wine that was on offer, but we had a really sort of good take-up with that and real positive feedback. You know, employees sometimes need a nudge from their partner. I think probably we're all familiar with that. So bringing them along, making them feel part of the whole process. We did run the risk that, of course, the employee hadn't shared some of the information with partners to start with, so I'm not sure if there any domestics came out of that, but I think it's an important process, because everyone has a slightly different view and everyone has a slightly different question. And the networking that went on after that evening session, literally we struggled to get them out the door. So the pension projection piece, I think we all know how difficult state pension projections can be. But understanding, and again it's picking up on one of Roz's earlier points, they've suddenly got this, they've not thought about it for years, they're just putting it away, they don't really know what it's going to mean. So getting them to understand what they need to do, what they can do, what level of support there through our administration function. We have a website where they can do their own projection modelling. And the consolidation piece is absolutely key. And it comes down to the let's not drive everything down this annuity which produces whatever it produces. You've got some money that you'll need easy access to, you've got some money that you might be prepared or willing to tie up for 3, 5, 10 years, and there's somewhere you might need to commit now to generating an income stream. And then these are the bits that got quite interesting. What are you actually going to do? And it is quite incredible how few people have a real clear picture of what's going to happen. So it's almost as if everyone's rushing towards this finish line, and actually when they get there, and they sort of turn around and it's, well, I don't know what I'm going to do now. So trying to get them thinking around that, and that was quite interesting with the partners. I think some of them had more of it planned out than they realised. But so the costs and how much you're going to spend, it comes back to one of our earlier points around I'm not going to spend much when I retire. And if you think sort of clearly about some of this, some of your expenditure will go down. Work suits, hopefully, will go down. Travel might go down because I've not got a season ticket, but actually I'm going to be out and about more during the day. Car expenses may be higher. Household bills are going to be higher because actually in the winter you probably sat there with the heating on all day as opposed to being out of the house. So we put together a sort of little grid of things that might stay the same. Your food expenses might generally be the same, and the things that will be higher, things that will be lower. And it's quite a powerful message when you put that up on a screen as to where all of these things slot in. Because at that stage, people then start to think, well, hang on a minute. I'm quite comfortable now, but I'm going to have income that's roughly half, hopefully, of what I've currently got. But I can see from there that 4 areas of my expenditure are going to be higher than they are now. So it does start to sort of focus the mind a little bit. Then, how do you keep yourself occupied? Now, it might be that you do voluntary work, you might go into a sort of final stage of education, you might learn to play the trumpet, or you might do some paid additional work to get that sort of retirement or late career income, and just sort of put a whole plan around not just the financial aspect, but how are you going to spend your time. Saying the classic sort of coasting along idea is, I'll play a lot more golf or we'll go on a lot more holidays, but that's probably not mentally stimulating enough for a lot of people. I think it's great to start with, but I think you need to give some thought to what's happening longer term. Okay. So what I thought I'd do is just summarise what some of these key points are. And these are the challenges I think that employers have got. And I've already said that trustees have got their own concerns and they have got their own responsibilities. I don't intend focusing on that. This is very much from the employer perspective. So I think we all agreed that from the day you start work to the day you walk out, hopefully, into a happy and healthy retirement is a pretty tricky road, really. There's going to be a few humps and bumps along the way. And I think this picks up on one of Jerry's points. The average employee is never really going to fully understand pensions. I'm not sure I fully understand pensions. So, what hope have people got realistically? So it's trying to get them up to a level where they can at least understand what they need to know is pretty important. I mean, I don't think the industry helps itself, frankly. The ever-changing sort of regulations, it is complicated. I think there's been some bad PR, quite understandably. So you can well understand a situation where an employee thinks, well, pensions, it's long-term, I've read terrible things about it, I'm not sure I'm going to live that long, and it's all very restrictive. And so there's a lot of work to do around that in terms of the wider financial picture. So we do focus on it. We do try and publicise our scheme. It is generous. It costs us a lot of money. We want people to appreciate it. But there's more than one horse in the race, really. So it's trying to get them to understand what the alternatives are out there. We've touched on this a number of times, but I think as a caring employer, I think there is a responsibility to support the workforce. I think you can't just bring them in, get them to do their day job, pay them their monthly salary and send them off. I think there's, at Schroder's, there's quite a strong cultural view around this, but I think as any sort of employer has a duty of care towards employees, really. So that's pretty important. We've touched on scheme trustees, and the regulator is obviously sort of leading the way in that area. So again, it's a bit of a step back time. So a lot of benefit programs have sort of evolved, and they're there because they were there last year, and actually they'll be there next year because they're here this year. And yes, we give a pension and we give some life assurance, and that's an employee benefit package. But I'm not sure that the average package now is particularly suitable to today's needs. And time will tell. I mean, I think the way in which we provide employee benefits is going to change quite dramatically. And I think I can see a move more to a wealth financial platform benefit with access, perhaps more to ISAs and unit trusts and different types of savings plans, rather than we're going to put X percent into the pension and aren't you lucky. So I think there'll be some challenges to come on that, and it may take some time. But I think if you started now as an employer and you were looking to reward employees, how would you actually do it? And I suspect with a clean sheet of paper, it might be quite different to how we currently do it. And this is a bit of a mantra for us, so sorry if it sounds a little bit twee, but the view very much is that if we support our employees, they're going to be engaged employees. And what we can do for them in the workplace has benefits for us as well. If you have engaged employees, if you have healthy employees, we have quite a big healthcare program, gym on site, this sort of thing, where there's a bit of an encouragement, and you want healthy and happy employees, you get much more out of them. And I am conscious, so we are in a very fortunate position that we are able to do a lot of this sort of stuff, and not every employer is. But there are some pretty easy wins in this space, actually. Okay, so we've done all of that. We've educated them, they've taken heed, they've had great plans, they've consolidated their finances, they know exactly what they're going to do in retirement, and it's going to be long, healthy, happy, etc. So it's all a bit of a relief, actually. So I'm not really sure what that says about a healthy and active lifestyle, but you sort of get the message. It's been a bit of a hard road. Everyone's a bit worn out, and actually it's relief, and let's all have a rest. But okay, so that was it. I just wanted to run through that very briefly. I'd say happy to take questions now. I think there's time for a bit of a panel discussion at the end. So a little bit off brief, but hopefully it's been of interest. Thank you.
Are there any quick questions for Neil at this stage? Observations?
Yeah. The key observation to me, I'm very impressed with that, is Neil's talked about financial education, advice, guidance and help through a career, whereas the previous speaker was all about advice. I'm absolutely in Neil's camp. We're not going to go near advice as an employer. how do we deal with the dichotomy between the two as an employer? And I think that has been dealt with. You've talked a lot, Rod's talked a lot about advice. Employers can do that. I don't think we can. We've got a legal challenge about providing advice. We can't do that, particularly if you're working for
it's a great question, and it'd be nice actually to hold that thought and to come back to that at the end, because some of the things that I want to say are actually pertinent to that particular point, because I think there is a middle ground. I think there are things that employers could and should be doing. I think there are things that trustees could and should be doing which don't go as far as technically giving financial advice. But it's a great question, and I know it stops a lot of employers from doing things.